Welcome, 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 and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, May 24th. Now, right off the bat, I must clarify that I am not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line during market hours, and from this podcast. Just this week, I wrote to my readers about whether it is a good time to buy Nvidia shares now or whether they should wait. Now, Nvidia announced their Q1 earnings report last week, actually this week, and they also announced a 10-to-1 stock split. Interest in the stock continues to be very strong, and the stock rose about 10% the following day. So the question is whether now is a good time to buy the stock, or is it better to wait until the stock has split, or perhaps even later? So please consider becoming a paid subscriber. Tell your friends and family. I'd love to have them and you join the growing Beachman community. Now, before we get into the meat of the episode, a few quick PSAs. This podcast is also available in YouTube format. If you go to YouTube and search for Market Whispers by Beachman or Invest with Beachman, you should be able to find my YouTube channel. The other thing I wanted to give you a heads up is that the transcript for this podcast is now available for reading in full screen format on the website for this podcast on the Substack website. Right now, this feature is only available on the desktop website, but it might be coming to the mobile app soon. The third thing I wanted to give you a heads up about, actually it's more of a request, to please take a few seconds to either drop a comment or like this episode if you truly enjoyed it. I'm personally too old to care about likes and thumbs ups on social media, but the algorithms on Substack and YouTube, well, they do care. Your likes and comments help with increasing readership engagement metrics, and that way the algorithms can encourage more people to find my writings, to find this podcast, as well as to join the growing Beachman community. Now let's get on to the meat of this episode. Well, as of today's close, the Dow Jones closed flat. The Nasdaq gained about 1% today. The S&P 500 also gained about 1%. And the Russell 2000 also gained about 1% as long-term rates dropped slightly today. So far for the week, the S&P 500 is flat. The Nasdaq has gained about 1.4% this week. The Dow Jones lost over 2% in spite of touching all-time highs above 40,000 points this week. And the Russell 2000 also lost over 1% this week. The best sectors this week were technology stocks that gained more than 3%, and the worst sector this week was real estate that lost 4% for the week. Investors seem to be focused on some old and tired themes over the past 2 weeks. Themes like a growing optimism for growth in the US as well as around the world, the fact that it's quite possible that there is no recession in sight, the fact that inflation continues to be trending lower after a much cooler than expected set of inflation reports, the fact that we have a strong jobs market in the US as well as in many parts of the Western world, and perhaps most important, the fact that many countries should be seeing, perhaps many of them are already seeing, a ton of fiscal stimulus in their economies, especially countries that are facing national elections this year. This year, in 2024, more than 45% of the global population will be entering the voting booth for their country's elections. In fact, just this week, the UK also announced elections that will happen, I believe, in June or July. So governments in these countries during election years tend to spend more freely in order to get reelected. And so all of this higher government spending tends to act as fiscal stimulus for their economies. And this leads to higher and higher stock markets. As I mentioned earlier, the Dow Jones Index, it hit all-time highs above 40,000 points this week. Now, Yardeni Research is calling for it to rise another 50% to 60,000 points by the year 2030. That's in another 6 years. Yardeni believes that the S&P 500 will also rise to about 8,000 points by that time. They're calling this their roaring 20s scenario. Along the way, there could certainly be corrections or even another bear market, but they expect that higher revenues and higher earnings within the S&P 500 as well as the Dow Jones stocks will drive these stock market indexes higher. Josh Brown from the Compound and Friends, he talked about the fact that since 1997, in terms of returns, the Dow Jones is up more than 400%, a five-fold increase in price, not including dividends. So including dividends, it's up even more than that. The S&P 500, again, excluding dividends, is actually up 600% since that time, since 1997. The NASDAQ Composite Index, the NASDAQ Index of tech stocks, has risen 1,000% or 10x during that same time period since 1997. Now, if we take a look at Dow theory, which suggests that the Dow Jones Index's recent rise to new all-time highs will not be sustainable unless it is confirmed by the Dow Jones Transportation Index. The Dow Jones Transportation Index remains below its record high at this point. So the transportation stocks need to also turn up higher in order to support the overall Dow Jones Index at its current levels and even push it higher. What's needed for these transportation stocks to move higher? Well, we need more consumer demand for goods, and we need relatively stable fuel prices. Right now, Q1 earnings season has told us that consumer demand for services as well as for goods remains a bit muted. Even though analysts believe that earnings would increase by just about 1.2% in Q1, earnings actually rose by 6.3% in Q1. However, most of those earnings, as we learned in the previous episode of this podcast, most of those earnings were driven or contributed by the top 6 or 7 mega cap tech stocks. So the transportation stocks will likely not go higher unless consumer demand for goods and services increases. And that doesn't seem to be on the cards, at least in the near term. Market trading internals indicate that there was a major bullish pivot a few weeks ago, and right now the internals remain positive. Therefore, we had a relatively stable to a higher 2 weeks. In the options market, the overall put-to-call ratio is at 52-week lows, meaning options traders are much more bullish today as compared to being bearish. History does suggest, though, that when this happens, when the put-to-call ratio is at 52-week lows, it's quite possible that a setback will soon take place. It's quite possible that we will have some sort of mean reversion, that we will have some sort of drop in the stock market, because options markets are way too bullish than they need to be. Corporate insiders might be giving us a little bit of a hint on this regard. Corporate insiders remain in a cautionary mode, primarily selling more stocks than they are buying today. So what's my take on the matter? What's my read on the markets? Well, I wrote to my readers this past weekend that I am confused about the markets, and I continue to be so even as of today, Friday, May 24th. It seems that markets are generally bullish, but still kind of in a choppy mood, moving up and down slightly here and there. So it's difficult for me to get a good read on where markets are headed in the short term as well as for the summer. This week we're introducing a new segment in this podcast called What's the Word on the Street? Now I'm trying to make this podcast a bit lighter and less wonkish. I got some feedback that I sometimes get into too much of detail in terms of macro reports and macro indicators. So I'm trying to make this podcast a little lighter and a little less dense. So in this segment called What's the Word on the Street, we will cover some important market updates and events. This will include some key macro updates, but I'll get into less detail. I'll cover mostly the highlights and the most important aspects of these macro updates. We will also discuss some important business updates that we received from Wall Street during the week that investors should know about. And by the way, this title, What's the Word on the Street? This title actually takes me back down memory lane when my son was about 3 to 4 years old. This is the way I used to put him to bed. There was a little segment on Sesame Street called What's the Word on the Street, where every day the Sesame Street characters would pick one new word out of the dictionary, and they would help listeners and viewers understand the meaning of that word. So my son and I would watch those little YouTube video clips every night before he went to bed. So let's get into What's the Word on the Street. Well, this week we learned that financial conditions in the US are hovering near their highest or loosest or easiest levels in a few years since the pandemic. What does this mean? It means that funding is more easily available for businesses as well as for investors. Funding is more available to be borrowed for investing in their current businesses, for starting new businesses, for acquiring new businesses, or perhaps even investing. As per Bloomberg, these financial conditions are similarly loose as compared to 2021, when meme stocks and SPAC stocks were flying high. Remember those heady times? It feels like markets don't care about interest rates anymore. Long-term rates don't care, don't matter. Fed's fund rates, don't care, don't matter. I will see your inverted yield curve and I will raise you higher stock prices every day, every week. We also learned about some shifts in consumer spending. Target reported their Q1 earnings this week, and they reported that consumers are downshifting from buying more expensive brand name items towards more reasonably priced store brand items. The rising price of beef has led to a surge in chicken consumption among Americans. Sales volumes of all chicken products are up 3% year over year in the past month or so. This shift is driven by consumers seeking cheaper alternatives as the share of their income spent on food hits a 3-decade high. Fast food chains are also seeing increases in chicken-related item sales. Wingstop reported a 22% increase in domestic same-store sales in the last quarter, in Q1. We also learned this week that Warren Buffett has been a net seller of stocks over the last several quarters. Now, the 13 Fs are a mandatory quarterly filing for any large investment firm. These 13 F forms are filed and publicly released about 45 days after the end of each quarter. And this mandatory filing also applies to Warren Buffett's Berkshire Hathaway company. So Berkshire Hathaway's Q1 13F filing was recently publicly released around the third week of May. And looking at that 13F filing, we learned that Berkshire Hathaway sold a large block of Apple shares. They also reduced their holdings in oil companies like Chevron. He sold all or most of his stake in companies like Paramount and Hewlett-Packard. And he's been buying shares of a company called Chubb, which is a property and casualty insurer. Now, here's the question I have as I look over Buffett's 13F filing. Berkshire Hathaway is sitting on record cash levels, and Buffett has acknowledged that the cash pile is only likely to grow further, grow higher. Right now, they're sitting on about $180 billion of cash. And he said that by the end of the quarter, by the end of Q2, they might even have about $200 billion in cash on their balance sheet. This means that there is more selling to come, that Berkshire Hathaway is likely to sell more of their shares. As today's markets continue to rise, as the stock market continues to rise, retail investors are coming into the market and buying more shares. However, Buffett seems to be selling shares at all-time highs. It is becoming harder for him to find attractive companies to buy at a fair price. And oh, by the way, Buffett just can't buy smaller companies, even though they're cheap, because he has billions of dollars to deploy. So when he makes a buy, he is going to start moving the price of that stock significantly if the news becomes public. So the question I continue to have is, why is Buffett selling so much? Why is he so bearish about markets today? How is he reading markets differently from all of us who are still mostly invested and helping push markets higher? What does he know that we do not? This week we also learned, in fact yesterday we learned, that the SEC, the US Securities and Exchange Commission, has approved several spot Ether exchange traded funds, ETFs. Now, Ether is Ethereum. It's the second largest cryptocurrency available today. So the SEC recently approved Bitcoin ETFs about 4 or 5 weeks ago, and now they have approved Ether ETFs as well. So Ether ETFs or ETH investors can now buy Ether ETFs in their brokerage accounts without needing to decipher the technical intricacies of crypto wallets and getting onto shady cryptocurrency exchanges. Now, the price of Bitcoin rose right after the Bitcoin ETFs were approved. However, the price of ETH has not yet moved much on this news. And the question I have for us to think about is, will we soon see approved ETFs for other cryptocurrencies? We also learned this week that Mike Wilson from Morgan Stanley, one of Wall Street's most prominent bears, Mike Wilson from Morgan Stanley has just turned positive on US stocks for 2024 as well as 2025. Mike is one of the largest bears we have seen on Wall Street for the last 3 years. He is, though, anticipating a 2% increase in the US stock market between now and June 2025. This is a significant shift from his previous prediction of a 15% decline by December 2024. Now, his year-end target for the S&P 500 is 5,400 points. We're already at 5,300 points. Mike actually missed almost all the gains in the markets last year in 2023. He was one of the most vocal market bears on Wall Street all year last year. And he started 2024 in a similar mindset, announcing or predicting that the markets would have a 15% decline by the end of this year. But suddenly Mike has turned bullish and he expects markets to go higher. Morgan Stanley is expecting earnings growth of about 8% in the US economy in the S&P 500 in 2024 and a 13% increase in earnings in 2025. And using this earnings forecast, they are extrapolating that by June of 2025, the S&P 500 will be at 5,400 points. Their bear case for June 2025 is 4,300 points, and their bull case, their most optimistic bull case, is 6,350 for the S&P 500 by the middle of next year. Now, Mike Wilson did write, he did acknowledge some of his past failures. He wrote, "Truth be told, our ability to forecast the S&P 500 last year has been very poor. And while we are confident that valuations are still too high, we have little confidence in our ability to predict the exact timing or magnitude of when these will normalize." So he is still saying that he believes the stock market is overvalued, but he believes now that he cannot predict when that valuation will come down to, in double quotes, normal values. And therefore, he's changed bullish now. Or I should say, cautiously bullish, just looking at his targets. Now, I think predicting where the index, where the S&P 500 is going to be for the upcoming week, the upcoming quarter or year or even next year is kind of a fool's errand. I went back and looked at analyst predictions from January for the rest of 2024. And almost all of them are wrong and way off as of today, May 24th. Some on Wall Street are actually taking Mike Wilson's reversal, the fact that Mike Wilson is now a bull. Some on Wall Street are actually taking this as a contrarian bearish signal. So when the biggest bear on Wall Street becomes a bull, perhaps it is time to go in the other direction and get bearish ourselves. Now let's talk about Q1 earnings. Well, we've gotten through most of the Q1 earnings report, although in my own portfolio, I've got about, I believe, 3 more companies that still have to report. But this week, the biggest earnings report that we received was NVIDIA's Q1 earnings report. Markets held their breath throughout the week until NVIDIA reported on the afternoon of Wednesday, May 22nd. NVIDIA reported another blockbuster quarterly performance. AI is still alive and kicking. NVIDIA delivered $26 billion in revenue this quarter. They beat revenue estimates, they beat earnings estimates, and they also raised their guidance for Q2 to $28 billion. That'll be more than 100% year over year if they hit that mark. NVIDIA shares rose almost 10% on Thursday, yesterday. The company is now bigger than Amazon and Tesla combined, with a $2.6 trillion market cap. NVIDIA is quickly closing in on Apple and Microsoft. Today, Microsoft is the largest company in the world, and Apple is at number 2, and NVIDIA is right there at number 3, quickly gaining on the 2 of them. The data segment in NVIDIA's business is the main driver for its revenue growth. Their data center sales rose 427% year over year in Q1. NVIDIA also announced a 10-for-1 stock split effective June 27th, and they raised their quarterly cash dividend by 150%. Meme stock GameStop also reported preliminary Q1 results this past week. They expect net sales of about $892 million, well below consensus expectations. They anticipate a net loss of $37 million in Q1. And guess what? To take advantage of the recent meme trading froth, GameStop plans to sell about 45 million shares in the open market soon. The stock has been volatile and mostly lower this week in response to this preliminary Q1 report. Target also disappointed investors with their Q1 earnings report this week. Their shares lost 8% after they delivered a minus 3% decline in comparable sales in Q1. They mentioned that the consumer has become much more cautious in terms of their spending. Discretionary spending has come down, particularly in home products and appliances and brand names. Now, AI has been the catalyst for this bull market all this year. It's no secret that there is strong enthusiasm among investors for any stocks or any companies involved in the AI revolution. Generative AI has been the driving force for this bull market, and it has pushed the S&P 500 up an impressive 46% since the lows of October 2022. Most of these gains are concentrated in the mega cap technology generative AI players in the US today. Investors are calling this the next technology revolution. Now, generative AI takes traditional artificial intelligence to the next level. Traditional AI is all about pattern recognition and trend prediction. Now, generative AI takes this to the next level. It learns from the data and documents that are fed into its engines, and it's able to then generate original new content. Investors expect generative AI to lead to future productivity and corporate profit gains within companies that adopt generative AI technologies and solutions. The hyperscalers are the companies with the very large data sets that are needed to train these generative AI algorithms. The hyperscalers have and own these large data sets. They also have the software expertise, and they also have the cloud infrastructure and the cost advantages that go along with ensuring that they could have the best chance of being the leaders in the Gen AI technology revolution. These megacap giants plan to spend over $180 billion in capex in 2024. That is a 31% year-over-year increase. 39% of S&P 500 CEOs expect to spend higher levels of capex this year, in fact, over the next 6 months, in order to try out and test and adopt AI solutions. AI software will also be needed to combat the current labor shortage we have in the country. We currently have a labor shortage because of various employment and job-related trends, job market-related trends since the pandemic. We also have an aging, retiring workforce, aka baby boomers. And this is also contributing to the current labor shortage in the US. And AI seems to be coming just at the right time to help combat this labor shortage. The IDC estimates that the global AI software market will grow from $64 billion in 2022 to nearly $251 billion. So that's about 4x by the year 2027, at a compounded annual growth rate of about 31%. Now, AI is also going to need a lot of power, a lot of energy to drive all those new GPUs in those expanded new AI data centers and AI factories. Now, the weekly stock bullfinder, he's a Substack writer that I follow. He wrote about this last week. Weekly stock bullfinder discussed and wrote that the supply versus demand tension between implementing new energy solutions as well as adopting artificial intelligence technology is quickly meeting the hard reality that these new AI technologies are going to require a tremendous amount of new mineral resources and energy supplies in order to meet ambitious targets and goals trumpeted by global leaders and governments all around the world. Copper is particularly seen as a green energy transition play, partly because of all of the wiring needed for these AI data centers, as well as an expanded power grid, as well as the mass adoption of electric vehicles around the world. It's estimated that data centers will require, the AI data centers specifically, will require an additional 1 million metric tons of copper by the year 2030. The problem is that we don't have that many new copper mines coming on board. New copper mines take about 10 to 15 years to start producing production levels of copper on a regular basis. The average is about 12 years. Now, EVs require almost 4x more copper than an average a traditional internal combustion engine car. So, for example, a normal internal combustion or an ICE Honda Accord needs about 40 pounds of copper. That same battery-powered Honda Accord needs about 200 pounds of copper in order to build that car. So EVs need about 4x the amount of copper today as compared to the normal internal combustion engine car. Onshore wind turbines, they typically need about 10 tons of copper. Offshore turbines need about 20 tons of copper in order to construct them as well as put them in place in their locations and connect them to the grid. Bloomberg estimates that by 2040, copper demand will increase by 53%, but the supply of that copper is only going to increase by about 16%. So we're going to have about a 35 to 40% deficit between the supply of copper coming online versus the demand of copper that we need at that time. The main reasons, as I mentioned, for miners not being able to keep up with demand is the fact that it takes about 12 years to get a new copper mine up and running. The permitting process for mining companies to open and operate a new mine is in the tens of years. The average time between discovering a new copper mineral deposit and getting a permit itself is about 20 years. So that's just to get permission to build a mine. After that, you have to actually build a mine, get it operational, and then start extracting production level volumes of copper that you can actually sell to the markets. There's also a lot of talk today in markets about uranium, about nuclear reactors potentially being the power source to power all these new AI data centers. Demand for uranium in nuclear reactors is projected to surge over the next decade, increasing by about 28% by the year 2030, and perhaps even doubling by the year 2040. This is primarily driven by the restarting of several existing reactors. There seems to be a trend of that happening in Europe especially, as well as a significant increase in new construction of nuclear reactors, especially in China and in India. The International Atomic Energy Agency forecasts that there will be a demand for about 200 million pounds of uranium by the year 2040. They also predict that by the year 2030, there will be a global shortfall of uranium by about 21 million pounds, and that shortfall will rise to 147 million pounds by the year 2040. Now, there are two main issues with nuclear power that investors should be aware of. One, at least in the Western world, no one wants a nuclear reactor in their backyard. They do support nuclear power, but they don't want these reactors in their towns and in their neighborhoods. The second important issue is the fact that we have not yet solved the issue of how to store and manage nuclear waste. We've not really found a viable, sustainable way of recycling or breaking down the nuclear waste that is created by these nuclear reactors. So the tension between the supply and demand, between AI technology and their energy needs, between AI technology and clean energy rollouts, is anticipated to only get worse in the coming years, as there exists a fundamental mismatch between the mineral resources that are available or that can be made available to create and power these energy solutions, as well as the demand that's coming from these new, larger AI data centers and AI factories. The other issue that investors need to also be aware of is the fact that there is a potential bottleneck to connect these new energy solutions to the US's national power grid. Why is this important to understand? Because recently in the search for new AI investment opportunities, investors have been bidding up and buying energy utility company stocks. Utility stocks are up more than 7% over the past month itself. Now let's try to understand why AI seems to need so much power. As per New Yorker, OpenAI's ChatGPT probably uses about 500,000 kilowatts of energy to respond to about 200 million requests a day today. The average US household uses about 29 kilowatts of power on a daily basis. So ChatGPT today is using about 17,000 times the power that an average home in the US uses today. A Google search query, in comparison, uses 15 times less power than a ChatGPT query today. So as AI adoption grows around the country, around the world, these AI solutions are going to need a lot more power than is available today. Today, data centers alone account for about 1/3 of all new US electrical demand. And AI data centers of the future are going to consume significantly more power than these traditional data centers of today. The North American Electric Reliability Corporation, they also recently published a 9-year growth forecast. According to their report, they doubled their forecast for the next decade. In fact, they had already doubled their forecast just a year ago, and they doubled it again recently in the last few weeks. So Bank of America also did some research on this front, and they found that there is a huge bottleneck in terms of new energy projects coming online and trying to connect to the power grid in the US. The typical power project that was built in 2023 took about 5 years to reach commercial operations, and this was up from 3 years about 10 years ago, and less than 2 years in 2008. So in 2008, it took about 2 years to get a new project, a new power project up and running. In 2015, it took about 3 years to get that new power project up and running. And in 2023, it took about 5 years to reach commercial operations for that same type of power project. Projects initiated between the year 2000 and 2018, less than 20% of them made it to commercial operations by the end of 2023. According to the Lawrence Berkeley National Laboratory, the US interconnection queue currently contains about 2,600 gigawatts of energy capacity just waiting to be connected to the national grid. That is up 30% in 2023 year over year. Now that's more than double the current capacity of the entire current US power plant fleet. We have 2x the amount of energy projects just waiting in the queue to be connected to the grid. If we take a look at solar capacity itself, 32 gigawatts, a record by the way, a record 32 gigawatts of solar generating capacity was added to the grid in 2023. But multiply that number by 30, and that's the amount of solar capacity that's just sitting in the queue waiting to be connected. So in simpler terms, in numerical terms, 1,080 gigawatts of solar capacity is waiting in the queue ready to be connected. And that amount of capacity could by itself just power 200 million homes in the US. Another way to think about it is that the backlog is currently 2x the current power generation capacity, and it will take about 5 years to get hooked up to even become operational and available. Now, there are two main reasons for this backlog. First is just the sheer number of new energy plants, new energy projects coming online all over the US. I mean, just the number of these projects all over the US is just completely overwhelming the queue and the capacity for bringing them online. And second is the permitting process that is needed to be followed, the paperwork that is needed to just get approvals, get everything up and running, get everything inspected, follow all the local laws and regulations, conduct all the technical studies that are needed and mandated by the various multiple approval bodies that are involved in those projects in the areas that they are located. As Bloomberg puts it, without connection to the grid, any energy project today might as well be an art installation. So as investors, why do we care about this? Well, as I mentioned, investors seem to be bidding up the stocks of utility companies over this past month in the hopes that these utility companies could be major winners in the future AI revolution. But as we've seen, these backlogs, the amount of time it takes to get these projects up and running, as well as the amount of time it takes to get them connected to the grid, can be measured in years and even decades. And this undercuts the investment thesis in these utility companies. The vast majority of these energy projects end up never getting connected to the grid due to both the higher connection costs as well as the major regulatory delays that prevent them from getting up and running in the first place. These projects are then forced to eventually withdraw from the queue, leading the capex spender, aka the utility company that we've invested in, leaving the capex spender or the utility company footing the bill, money down the drain. As long as these potential energy projects remain in the queue and don't get connected to the wider US electric grid, the positive impact that they could have is completely nullified. Utility companies will not make money, and investors will be left with stocks that do not perform. For all the reasons mentioned earlier, I personally do not find power companies and utilities as an interesting and attractive way to invest in AI. I am much more focused on investing in semiconductor companies that are today selling AI GPUs, AI semiconductors at very, very attractive profit margins to the hyperscalers that are building out these new AI data centers. I am also more interested in investing in commodities that could be used, that are being used in these massive industrial and energy projects. I'm interested in and taking a closer look at commodities like copper and aluminium that are used in grid transmission and in solar. Commodities like lithium, nickel, cobalt, manganese, and graphite. These are used in batteries, new battery technologies, and battery storage plants. Even rare earth elements are used in wind turbine related technology. The makers of industrial cables, they seem to be an interesting industry to take a closer look at. Industrial cables, optical cables, these are used for power transmission. Industrial metal-based cables are used for long-distance power transmission, and optical cables are used for shorter distance power transmission and grid connections. I am specifically very interested in copper as a long-term investment opportunity. Copper prices hit new highs just this week before they corrected lower by the end of this week today. Copper is often referred to as Dr. Copper, as a leading indicator of the health and strength of the economy. Goldman Sachs recently revised their own year-end price target for copper as a commodity. They revised their year-end copper price target by about 20% higher. Now, copper is a very malleable, conductive, and ductile metal, and this makes it very suitable for use in many industries like manufacturing, automobiles, electricity or electrical grids, as we've talked about it, consumer electronics and electricals, as well as in construction. We discussed earlier about how copper is one of the key components in electric vehicles, needing about 4 to 5x the amount of copper in an EV as compared to a traditional internal combustion engine vehicle. Copper is also one of the main components for connecting renewable energy infrastructure with the grid as well as within those renewable energy components themselves. Copper is used in hydroelectric power projects. It's used in wind turbines as well as in solar panel installations. The increasing adoption of clean energy around the world is driving higher and higher demand for the metal. Demand for copper is expected to double by the year 2035. That's about 11 years from now. Now, China has traditionally been the largest buyer of copper in recent times, but China's economy is in the doldrums. Their economic growth is slowing down. China's economy is also undergoing a transition from a traditional goods manufacturing economy, from a very large real estate economy, to a more of a clean energy manufacturing economy, the manufacturing of EVs and batteries and solar energy components. As China recovers broadly, this might take a few months to plan out. As China recovers broadly and starts competing in these new clean energy, these new emerging clean energy industries, their demand for copper will only increase. India is also lying in wait with their potential demand as they become a larger global industrial and manufacturing economy. Demand for copper is expected to go through the roof. My interest in this metal is very high. I believe this is one of the more interesting ways to invest in the AI energy demand theme. So what's coming up in the markets over the next 2 weeks? Well, Monday, May 27th is Memorial Day here in the US, and US markets will be closed that day. Oh, by the way, there's a Fed committee member also giving a speech on Memorial Day, Monday, May 27th. These folks love giving speeches. Insert facepalm emoji here. And by the way, there are more Fed speeches coming throughout the week next week, so be ready for that as well. On Tuesday, May 28th, the Conference Board will release their latest consumer confidence report for the month of May. On Thursday, May 30th, we'll get the second estimate for the Q1 GDP growth in the US. We got the first estimate a few weeks ago, and that came in at 1.6%. So we'll see whether the second and most recent estimate is higher or lower. Chances are it's going to be pretty close to the 1.6% reading that it gave us last time. On Friday, May 31st, we will get the PCE inflation report for April. Remember, this is the inflation report that the US Feds look at very closely, and this is what they use as they decide what to do with interest rates. On Monday, June 3rd, we'll get the ISM manufacturing report for May. On Wednesday, June 5th, we get the ISM services report for May. Both these reports will tell us whether manufacturing and services activity, industrial and economic activity is growing or shrinking in the US in May. On Friday, June 7th, we will get the US jobs report for the month of May. And that will be a very closely watched report, and markets could move higher or lower depending on what we see in that report. So that's all I have for this episode of the Market Whispers podcast. Do drop me a comment or question anytime. I always love to hear from you readers. Hit the like button if you liked what you heard or read in this episode. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest: for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.